Does this explain a little bit the very small increase, that 100,000 barrels that we saw from OPEC at the last meeting?
Well, that's actually quite interesting. If we look at the political prism of that, this, of course, came on the heels of the visit to Saudi Arabia, or the visits actually of President Biden and also President Macron. So we can perceive that OPEC did not want to necessarily rebuff the U.S. and also Europe in terms of whether it would increase oil supply. But at the same time, we can see that OPEC did not want to unduly antagonize Russia. But if we really dig deeply into this, Brandy, if we look at the structural elements of this, OPEC simply does not have the overall spare capacity that is required to drastically increase any type of oil supply. I mean, so the only two countries that we have that have any material let's say, spare capacity to speak of would be Saudi Arabia and the UAE and potentially Kuwait. The rest of the OPEC countries are hurting, and particularly if we look at Nigeria and Angola. So even though OPEC could have made, let's say, a type of big statement, a big announcement that it would increase it significantly, but at the same time, it would be extremely difficult for it to do so. And then if I can make one other point, OPEC feels that there should be enough spare capacity that is held as a buffer in case there's any type of severe supply disruption at the same time.
So what might we see based on this from OPEC going forward, Justin?
Well, I think OPEC has signaled that there aren't going to be any, let's say, substantial production increases moving forward. I mean, so that's one thing that we can definitely recognize. And I think that OPEC feels that the markets are more or less well supplied at the moment.
Okay, so let's take the IEA report. How much is the European gas crisis impacting the demand for oil, or rather, how much could it over winter, and what could that mean for prices?
Well, that's actually a very good question. So basically what the IEA believes is that the reason why it revised its figures upward is because it sees that there has been a significant increase in oil utilization for power generation and also gas to oil fuel switching. And this has been driven, of course, by high electricity prices and also by high natural gas prices. So when we look at it overall, we see that there has been heat waves that have been popping up, of course, in the Middle East, Asia, and Europe, which have been driving, obviously, the electricity demand higher. And then we also have the political posture of Europe, which wants to transition away from Russian natural gas. I mean, so this has been driving the increase of the fuel switchover of oil in power generation that we've been seeing. Now, come this winter, well, it's really anyone's guess how Russia is going to react, because we have seen Russia taking some fairly, let's say, aggressive steps to signal or to telegraph to Europe that it also has a few weapons in its arsenal to respond in kind if Europe seeks to impose sanctions.
Slightly stupid question then here, Justin. How is it then at the same time that we're seeing global petrol prices going down below $4 on average, $3.99 at the moment in the US?
Yes. Well, I mean, the reason for that is that we have had, at least in the U.S., inflation has actually lessened. I mean, so that's one slight aspect. And then when you look at the increase in oil prices that have occurred, of course, over the past few months, there was a bit of demand destruction that has occurred from that. So people have been watching, let's say, how often or how far they're going to drive and so on. So, I mean, that really has been, it had a moderating, I guess, impact, you could say. And then in addition to that, there have been increase in storage capacity that has occurred within the U.S. and also other countries as well.
Thank you very much for joining us from Washington this morning. Before we let you go, Justin, tell me, 30 seconds, where are prices going? What does all of this mean for how much people are paying for oil?
Well, I would say when the full ban, the EU's full ban, kicks in about February of 2023, that would take an additional about 2 million barrels off of the market. So I think we could see perhaps a price spike at that time.
Justin Dargin, now working for Carnegie Endowment, speaking to us from the States this morning. Thank you very much for your time.